Good afternoon. Luberoff, the Joint Center's Director of Fellowships and Events, and it's my pleasure to welcome you to today's webinar on whether and to what extent the mortgage lock-in effect contributed to the rapid rise of mortgages, particularly COVID era. Before we get to today's talk, a couple of announcements of upcoming events and talks. Next Thursday, March 12th at 4 o'clock, the Joint Center will release our America's Rental Housing 2026 report at an online event that'll feature a presentation by Whitney Ergodabricki, a senior research associate here at the center who has directed the team that's producing that signature report. That'll be followed by a panel discussion with Sue Ansell, President and CEO of Gables Residential, Lachelle Dozier, CEO of the Council of Large Public Housing Authorities, Denver Mayor Mike Johnston, Chris Herbert, the Joint Center's Managing Director. That'll be moderated by Rhonda Kaysen, the real estate reporter for the New York. It should be a great discussion. We'll take the following week off because it's spring break, and then we will return on Friday, March 27th, with an online webinar with Michelle Lee, who, like today's speaker, is a PhD student and one of our Meyer doctoral dissertation fellows. She'll be talking about whether and how rail trails impact home prices and neighborhood demographics, with a particular focus on Greater Boston, but also with a new national data set as well. And then we have a bunch of other upcoming events. I do want to highlight on Friday, April 10th, online and in person, we'll be having a half-day event focused on innovative approaches to encouraging intergenerational housing and communities. More information about these and everything else the center is doing is available on our website. Now let's talk. Our speaker today is Justin Katz. Like Michelle, Justin is a Meyer doctoral fellow. He's a PhD candidate in economics who'll be graduating later this spring. He will be discussing research he did with support from the Meyer Fellowship that resulted in a new working paper co-authored with Robert Minton, exploring whether homeowners locked into below market fixed rate mortgages chose not to move and to what extent this may have contributed to the sharp rise of housing prices during the pandemic. Justin's going to talk for about 40 to 45 minutes, and then he'll take questions for about 15 minutes. I'll moderate. I will draw on questions you submit to Q&A, so please submit thoughtful questions. Apologies in advance if we don't get to all of your questions, but we will share them with Justin so he'll know what folks were interested in. Up by 1:15 p.m. Video and copies of the slides will be posted to our website early next week. Justin, it's all yours.
Great. Thanks, David. So first, thanks so much to David and all the organizers for putting together this event. I'm very excited to discuss my research, which studies the house price effects of mortgage rate lock, which is one of the more important housing market developments in the US in the last few years. This paper, as David says, is joint with Robert Minton at the Fed Board. So between the end of 2021 and 2023, interest rates went up a lot. So the interest rate on a new 30-year fixed rate mortgage rose from around 2.5% to almost 8%. Now, many expected this surge in borrowing costs to crush house prices, with the chief economist at Moody's predicting a 10% decrease nationally. That was roughly in line with the consensus among forecasters. Instead, since the end of 2021, the real price of existing homes has continued to rise. Now, one potential explanation is that the negative impacts of higher interest rates on home buyer demand were partly offset by reduced resale supply from existing owners. Now, in the US, many existing owners have outstanding fixed rate mortgages with interest rates around 3 to 4% over this period. Now, this could create mortgage rate lock, where by mortgage rate lock, I mean a financial incentive to keep a current home and an existing low rate mortgage rather than selling a home and facing a new higher mortgage rate. Now, consistent with the rate lock hypothesis, sales fell by about 40% over this period. And in 2023, Jerome Powell attributed high house prices to mortgage rate lock, which reduced resale supply. Now, this view is expressed in the financial press and among asset managers, but the underlying logic isn't actually all that obvious. So academic research shows that rate lock reduces household level moves, which means it reduces the number of existing home sales. But if there are fewer home sellers, then there are also fewer home buyers because there are fewer people shopping for new homes. In other words, rate lock reduces existing home both supply as well as demand. And although this will decrease transactions, it doesn't obviously impact house prices. Now, according to this alternative view, recent price growth instead reflects other factors like the rise of remote work, leading to increased owner occupied housing demand. Now, more broadly, this episode raises some unanswered questions for how fixed rate mortgages impact housing market equilibrium when interest rates rise. Now, first, in theory as well as empirically, what is the impact of rate lock on house prices? Now, we're going to document positive and meaningful effects, at which point a natural next question is, in the aggregate, how large is the rate lock effect relative to the negative house price effects of an increase in user costs due to higher cost of new borrowing and in a higher opportunity cost of capital when interest rates rise? Now, we're going to find a large positive rate lock effect, but one that is smaller than the negative user cost effect, which means that rate lock isn't the full story for why house prices recently rose. Now, in this presentation, I'm going to do three things. So first, I'm going to give an important theoretical condition for rate lock to impact aggregate house prices, which is segmentation between owner and renter markets. We find that aggregating across all owner-occupied housing markets in the US, rate lock reduces moves by owners who would have otherwise exited to the rental housing market, which reduces the net supply of existing homes and increases aggregate prices relative to rents. Then we'll give two sets of empirical facts to show rate lock's price impacts. First, we'll estimate the effect of a local housing market's average outstanding mortgage rate in 2021 on house price growth from 2021 to 2023, the period when interest rates rose. Now, the challenge in doing this is that a local housing market's average outstanding mortgage rate is closely tied to housing market fundamentals that might otherwise explain price changes, which will bias our estimates. Now, our solution is to identify natural experiments that reshuffle the timing of mortgage origination across different housing markets. Now, our main approach is going to use unexpected moves from having kids that create mortgage origination at times when interest rates might happen to be either higher or lower. We find that these experiments are an important predictor of the rate lock incentive for households. And across housing markets, they imply that rate lock can explain roughly a third of the 24% increase in nominal house prices from 2021 to 2023. Then we look at the behavior of individual households to understand mechanisms that drive this result. And we show that households who have lower outstanding fixed rate mortgages are less likely to move from owning to renting, which is kind of the key result that implies rate lock can increase aggregate house prices relative to rents. Finally, we quantify how much rate lock offsets the negative user cost effects of an increase in interest rates. And we do that by estimating a model. We find that in aggregate, rate lock has a significant positive price effect, but one that's smaller than negative user cost effects, which means that even with rate lock, an increase in interest rates still predicts a decrease in house prices. We also use the model to simulate what would have happened to house prices under different mortgage contracts, where we consider, for example, adjustable rate mortgages or portable mortgages that borrowers can take with them into new properties when they move. Now, the results of this counterfactual analysis shows that the key frictions that determine the price impacts of rate lock are that interest rates are fixed, as opposed to other frictions like non-portability. Now, in the interest of time, I'm going to skip the related literature and just dive right into a simple conceptual framework to show, in theory, how rate lock can affect prices. Now, this is going to be very stylized, but hopefully illustrates the important channels. Now, I want to think about a city that has two housing market segments. You can think of these as neighborhoods in a city or rungs on a quality ladder. Now, within each segment, all units will either be owned with a mortgage or rented with rents paid to landlords. And I'll assume that the number of units within each of these segments is fixed. That's going to take off the table, for example, landlords being able to convert their one-bedroom urban apartments into single-family detached homes that are owner-occupied in the suburbs. Now, we'll assume that rents are fixed, and so all of our results are going to tell us about house prices relative to rents. Now, the city will have a fixed population of households who occupy one unit at a time, and they can decide to stay in their current unit or switch to a different one, where they'll try to minimize the present value of housing costs, where they'll discount future housing costs, which are either mortgage payments or rental payments at a rate that's related to the risk-free saving rate in the economy. And this is just a convenient way to capture the impact on people's kind of total wealth if they were to continue paying whatever their housing costs are in the future. Now, with this, we can ask how fixed rate mortgages impact the decision of households to move when interest rates change. So if an owner occupant with a fixed rate mortgage decides to move, they have to clear their mortgage debt, which means that they'll have to repay their outstanding mortgage balance. Now, what they get back in kind of present value wealth terms is just the present value cost of mortgage payments that they would have otherwise had to make if they stayed in their homes. Now, for example, if you have a mortgage with a $200,000 balance with a 3% fixed interest rate, then payments will be $6,000 each year. If market interest rates are also 3%, then when you discount those future payments, the decision to move and repay your mortgage will kind of leave you in a neutral position. However, if market interest rates rise, then you're better off staying in your home as opposed to selling, which means that selling your home and repaying your fixed rate mortgage is going to lead to a prepayment cost. That is a gap between the mortgage balance and the present value cost of payments if you were to stay in your home. Now, this prepayment cost due to an increase in market interest rates means that people have an incentive to stay in their homes rather than moving and repaying their mortgage, which is going to reduce moves between owner-occupied units, and it's also going to reduce moves from owning to renting. Now, these prepayment costs, because of an increase in rates, is not going to have any incremental impact on moves from renting to owning because, of course, renters don't have fixed-rate mortgages. Now let's see how these prepayment costs impact equilibrium, where we'll consider two simple cases. In the first case, there's not going to be an impact on aggregate house prices, and in the second case, there will be. So in the first case, let's assume that each of these housing market segments, so again, neighborhoods or rungs on a quality ladder, have owner-occupied units. We'll just label the markets A and B. And equilibrium in these markets is going to be in the relative price of units in A compared to the price of units in B, which is just going to equate supply and demand of units. Where the supply of units in A is just the number of people moving from A to B, and demand for units in A is just the number of people moving from B to A. Now, what happens when market interest rates rise? That's going to create prepayment costs for owners in both A and B and leads to a shift inwards in both these demand and supply curves. Now, if markets are symmetric, these shifts are going to be the same. And so although there will be an impact on sales, there's not going to be any impact on relative price. Of course, if markets are different, then the market with the relatively larger increase in prepayment costs, the rate lock incentive, it's going to see the relatively larger shift in and hence relatively higher prices. But even in that case, when you average across the two markets, you're not going to see any aggregate price effect. So next, let's consider a case where there will be an impact on aggregate house prices. In this case, let's assume that one market segment has owner-occupied units and the other has rental units. Now, equilibrium is still going to equate supply and demand, but it's going to be in the relative price of owner-occupied units compared to rents. And supply is now going to be the number of people moving from owning to renting, which is roughly 1/3 of total moves by owner occupants. And demand is going to be the number of people moving from renting to owning. Now, what happens when interest rates rise? Well, it's going to become more expensive for renters to buy, which will shift in the demand curve. And it'll also become more attractive for owners to rent because essentially they want to put their home equity towards just risk-free savings when the interest rate rises. Now, if people had no mortgages, then all you would see is a shift inwards in the demand curve and a shift outwards in the supply curve, and house prices would fall. This is kind of what people talk about in terms of a user cost effect, where an increase in interest rates reduces demand for home ownership and decreases house prices. However, if owner occupants have fixed rate mortgages, then they also face an increase in prepayment costs when interest rates rise. This attenuates the size of the shift outwards in the supply curve and leads to relatively higher house prices. Now, what we learned from this example is going to motivate the empirical analysis for the rest of the presentation. So first, I'm just going to estimate empirically mortgage prepayment costs for outstanding fixed rate mortgages. And then I'll look across geographic housing markets to estimate how a change in prepayment costs impacts house prices, focusing on the period from 2021 to 2023. Now, the results of that analysis is going to give us a combination of those own-to-own forces that don't have an impact on aggregate house prices, as well as an impact on the own-to-rent forces, which do. And so to isolate the strength of the own-to-rent mechanism, we're also going to look at the behavior of individual households to see how rate lock impacts the decision to move from owning to renting. Finally, we'll use those household level effects to estimate a model, which we can use to separate out the price impacts of rate lock relative to higher user costs when interest rates rise. And we'll also use that model for our counterfactual analysis. Now, to do all of this, our primary data set is going to be a monthly panel that links the near universe of mortgage servicer records for households with consumer balance sheet and demographic information that comes from credit bureaus. This lets us infer existing home sales, as well as estimate household level prepayment costs at a way that's scaled by a measure of households' income and wealth. This lets us see how important these prepayment costs are relative to other potentially non-financial reasons to move. Now, we also update on the near universe of residential real estate records, as well as some other data sets, but I'll only bring those up as necessary. So the first step is just to estimate what prepayment costs look like for the typical outstanding mortgage in the US. Now, our main measure of the rate lock incentive is what we call scaled prepayment costs. This is what a household gives up if they decide to move and repay their fixed rate mortgage, as opposed to staying in their home and keeping their low mortgage rate. Now, what they give up is essentially the difference between their mortgage balance and the present value cost of repayments on their mortgage were they to stay, which is just the exact same as prepayment costs from the simplified model that I was showing you earlier. Except we're going to additionally scale by the appraised value of individual housing units, just to put things in kind of common wealth terms, looking across households. Now, for people with a little bit more of a finance background, you can think of this as the gap between a mortgage's book value and its market value. Now, we observe the book value directly. We see the mortgage balance for each person, but we have to make some assumptions to estimate how people perceive the present value cost of payments to be costly. And in particular, we're going to account for the fact that interest rates are expected to change over time by just discounting future payments with an estimate of the Fed's nominal yield curve. This accounts for the fact that people might realize that interest rates are high today, but it'll decrease in the future. And we're also going to incorporate the value of the option to refinance, the fact that current homeowners know that in the future they can refinance their mortgage if interest rates change. Now, scaled prepayment costs kind of change in intuitive ways, looking across households and across time. So prepayment costs, that is the rate lock incentive, is going to be higher for mortgages that have a lower mortgage rate, a higher loan to value ratio, or a longer remaining term left on the mortgage. And looking across time for an individual mortgage, prepayment costs are going to increase when market interest rates rise, because the present value cost of fixed mortgage payments is going to fall. And prepayment costs are going to decrease when interest rates fall, up to the point at which it becomes optimal to refinance. Now, to better understand some of these points, it's helpful to just look at what scaled prepayment costs look like for the average outstanding mortgage in each year from 1992 to the present. So the black dashed line plotted on the right axis in this figure shows the average interest rate on a new 30-year fixed rate mortgage. And the blue solid line on the left axis shows the average scaled prepayment cost for outstanding mortgages. Now, you can see that from essentially 1992 to 2021, when market interest rates were declining, people basically did not face any prepayment costs. There was no rate lock effect. However, from 2021 to 2023, when market interest rates started to increase, there's a huge increase in the rate lock incentive and scaled prepayment costs. That means to really understand the equilibrium effects of mortgage rate lock, it's important to focus on the recent tightening episode. Now, we find that an important driver of how much prepayment costs change from 2021 to 2023 is the mortgage rate that was outstanding in the market when a given mortgage was originally originated. So what I'm doing here is I'm grouping mortgages based on their origination year and holding fixed their initial characteristics, and then seeing how much prepayment costs change between 2021 and 2023 for each of these origination cohorts. And you can see that mortgages that were originated in the 2000s and had a relatively high mortgage rate have a fairly small increase in prepayment costs, whereas those originated in the 2010s have a much lower mortgage rate and hence see a much larger increase in prepayment costs when rates rise. Now, I want to emphasize that these magnitudes are quite large. So a value of 0.1 means that the present value incentive to stay in your home rather than selling due to your fixed rate mortgage increased by 10% of your property value between 2021 and 2023. That's like a $30,000 incentive to stay rather than move if you have, the median home value of about 300K. Now, you should expect a $30,000 incentive to stay to be enough to move housing markets. And so next, let's estimate what the empirical effects of those incentives are on market equilibrium, focusing on the important period from 2021 to 2023. Now, we're going to define housing markets as zip codes and then estimate the effect on zip level house price growth from 2021 to 2023 on the zip level change in scaled prepayment costs from 2021 to 2023. That's the rate lock incentive, where we'll estimate zip level price growth using a repeat sales index that's going to control for quality differences in the composition of sales over time. And we'll estimate the change in scaled prepayment costs, the rate lock incentive, by just taking the zip level average of outstanding mortgages in 2021. Now, as we discussed, places that have a lot of mortgages originated when interest rates were low will have a larger increase in prepayment costs between 2021 and 2023. Now, this could bias our estimates because there are many unobservable reasons why a given area might have a lot of mortgage originations in low rate periods and either higher or lower price growth from 2021 to 2023. I'll just illustrate two potential issues to show that the direction of this bias is not obvious. So at times when interest rates are low, you typically have an increase in housing demand, which generates more moves and hence more mortgage originations. Now, what types of markets do those moves go towards? On the one hand, people are likely to move where housing units are available. That's typically suburban markets where it's relatively easy to build. That means that there's going to be a higher increase in prepayment costs in places that are likely to see less price growth from 2021 to 2023 because housing supply is very flexible in those places. On the other hand, when interest rates are low and people decide to move, they might move towards places where they expect price growth to be especially high. For example, gentrifying neighborhoods within a city. Now, if those expectations are right, then you're going to see an increase in prepayment costs in places that see higher prices, not because of rate lock, but instead because of unobserved amenities shocks, for example. Now, in line with these concerns, if you look at where the rate lock incentive is high, the markets with high increases in prepayment costs look very different than the typical market. So in gray, I'm showing you the results from a regression of the change in prepayment costs from 2021 to 2023 on local housing market characteristics. And you can see that there's lots of correlations with things like age, income, and risk characteristics, which means that there might also be unobserved differences across these markets. That's going to lead to bias in our estimates. So what we want is a natural experiment that creates random variation in when people happen to get their mortgage, which will create variation across markets in the rate lock incentive. And so to do that, we're going to take an instrumental variables approach where we'll predict when people get their mortgage using some kind of effectively random shock. Now, our main approach is to predict moves from when people have kids. The idea here is that for an individual household, having a child kicks off a predictable sequence of moves as the kids age, which means that for housing markets, the timing of births impacts the entire trajectory of churn, that is, moves into and out of an area. In places where we predict high churn, when interest rates are low, we expect a high inflow of low rate mortgages, which means that in 2021, the outstanding mortgage stock has low interest rates and hence experiences a greater rate lock incentive when interest rates rise. Now, we're going to take two approaches that have kind of pros and cons. The first approach will use the unexpected shock from parents having twins rather than one child, which at least mortgage brokers in East Lansing, Michigan appear to know is likely to cause moves. Now, to be very clear on the variation that we're going to be using differences across places in changes in the twin birth rate. That is the fraction of births that are twins. And we'll find that that variation looks like it's essentially driven by just random binomial finite sample variation, which is basically just a technical term to say that the variation is effectively random because of sampling noise. Now, the first thing to establish is that having twins rather than one child actually does create predictable moves. And so to do that, we're going to regress moves in a given zip code on leads and lags in the local fraction of births that are twins. And I'm showing you the results here, which show how a twin of age A impacts moves for a given household. Now, you can see that there are no kind of leading indicators of moves, which implies that for a household, a twin pregnancy is actually unexpected. When twins are born and parents realize maybe they need an extra bedroom, or grandparents decide to move next door to help out with childcare, you see a big increase in market level moves. And that difference persists for about 12 years until the twins leave elementary school, before dying out to essentially 0, 15 years after moves, after the twins are born. Now, we're going to use differences in the path of the twin birth rate in individual markets, along with these estimates, to forecast moves for the period of between 1995 and 2021. We'll then use those forecasts to predict the fraction of outstanding mortgages in 2021 that are originated in each period due to twin-driven moves, and use that to construct our instrument. Now, I'm just going to give you a simple example of how this works using a graphical example, and then show you how this works in the data. So let's think about two housing markets, A and B, that are sort of ex ante the same, with 2% of births that are twins. Let's say that in market A, just due to random sampling noise, there's 3% of births that are twins, whereas in market B, only 1% of births are twins. We estimate that that leads to more moves in A relative to B in 2005. But it's also going to lead to more moves in 2011 in A compared to B, as the twins enter primary school, even if the fraction of births that are twins in 2011 is now back to being the same across these two markets. Now, as it turns out, 2005 and 2011 are both years where the mortgage rate was low relative to the pre-2012 average, which means that by 2021, the average outstanding mortgage is likely to be lower in A compared to B, and hence A will see a larger increase in prepayment costs. Now, that's how this can work in principle. I'm just going to show you how this works for two actual housing markets in the data. So here I'm plotting the twin birth rate between 1995 and 2006 for two zip codes. One is blue and one is red. You see that it bounces around, but there are no kind of clear differences across these two areas. But based on our previous estimates, if you look at the moves that are forecasted based on this variation, you see that it implies the red zip code experienced relatively more mortgage originations in the low rate 2010s relative to the blue zip code, which means that in the red zip code, the average outstanding mortgage in 2021 is more likely to have low mortgage rates and hence a larger increase in prepayment costs. Now, we're going to do that kind of for every zip code in the data. And when we look across all of the zip codes, we find that places that have a high predicted rate lock incentive due to this twin variation indeed do seem to have a larger increase in prepayment costs just unconditionally. Now, what this tells us is that kind of variation of the path of twin births in different areas kind of reshuffles origination timing in a way that does actually create differences in the rate lock incentive across locations. Now, the next thing to establish is that this variation actually is quasi-random. Now, to do that, we hypothesize that the year-over-year change in the fraction of births that are twins is essentially driven just by sampling variation. In some years, you happen to get more twins, in some years, you happen to get fewer. And to see this, in blue, I'm just showing you the distribution of the change in the twin birth rate. And I'm benchmarking that against, in red, results from a simulation where I'm just taking random draws from a distribution that's estimated using the data. And you can see that the year-over-year change in the data is kind of exactly what you would expect if this were just due to random sampling. Now, as further evidence, if you then regress our twin instrument against the same demographics as before, which I'm showing in blue, you can see that there's no correlation with things like the local age distribution, local income, the local racial composition, which implies that these shocks truly are random. Now, we also take a second approach, which uses kind of a larger shock based on differences in the number of births to first-time mothers. You can think of this as like a family formation shock for households, which is also going to lead to moves. Now, we follow the exact same steps as I was showing you before. This is going to cause a lot more variation. But as is always the case, when you kind of use more variation in the data, we also start to introduce some potential confounds. So it turns out that the first births instrument is not quite as clean as the twins instrument. An advantage of both these approaches is that they can be constructed with public data and so used to study any outcome in housing markets that depends on when people move to a given area. So now let's look at some results. Remember, I'm regressing price growth on the change in scaled prepayment costs. That is the rate lock incentive. And then this table is just going to show you the coefficient on the pass-through. So the first column shows the results where we just run this regression without an experiment. And you actually don't see that much, which is consistent with some of the biases I was describing before. The third column shows the results where we use our twins natural experiment, where now you see a positive and statistically significant effect. Now, I'm going to interpret this in two ways. So first, this implies that a 0.3 percentage point decrease in the average outstanding mortgage rate in 2021 in a given market causes an increase in price growth from 2021 to 2023 of about 2.6 percentage points. So that's a fairly significant effect. Now, what's perhaps more intuitive is just to ask, how much lower would house prices be in 2023 if we eliminated the outstanding rate lock incentive? And these estimates imply house prices would be about 8 percentage points lower, which would reverse roughly 1/3 of the 24% increase in nominal house price growth between 2021 and 2023. Now, we get very similar estimates if we instead use our kind of family formation first births natural experiment, which gives us confidence that we're estimating kind of a representative effect on these markets. Now, according to our theory, the reason for higher price growth in these markets is because there's relatively less market exit. That is, there are fewer owners who are selling their homes and moving to a different market, either a different owner-occupied housing market or to the rental market. Now, to test this, we run the same regressions, except take as our outcome variable the probability of moving between 2022 and 2023. We see that kind of regardless of the methodology we use, an increase in the rate lock incentive does lead to a decrease in moves out of a given housing market. And I'll just flag that in columns 3 and 4, where we saw much larger price effects, we also see relatively larger price outflow effects relative to just sort of the more naive approach without an experiment, which again gives us confidence that we're actually picking up the price effects of something like the rate lock mechanism. Now, just to briefly interpret this implies that removing rate lock in 2023 would increase outflows by about 48%, which means that rate lock actually is quite important at explaining the low levels of moves in recent years. Now, in the paper, we do a lot to try to unpack the mechanisms that drive these results. I'll just highlight one result, which is particularly important, where we find that the price effects of rate lock is much lower in places where it's very easy to build. The reason for that is because rate lock is really only going to have an impact on prices if the decisions of existing owners are what's important at determining the availability of existing homes or of housing units. If instead it's very easy to build, then builders can essentially provide the incremental unit of available supply, and the decisions of existing owners aren't going to affect prices very much. We also do a number of robustness checks. In particular, we redo the twins instrument, stripping out births due to in vitro fertilization, and we get essentially the same results, which implies that we're not picking up some weird effects or confounds due to IVF utilization. And then we also look at other outcomes, for example, impacts on residential investment, that is new construction, as well as impacts of rate lock on rents. But in the interest of time, I'm going to take a step back and understand what our estimates imply for house prices in the aggregate, and to try to simulate the counterfactual impacts of an increase in interest rates under different mortgage contracts. So far, we've looked across local housing markets to understand how rate lock impacts prices. But now we want to better understand how rate lock affects the impact of an increase in interest rates on house prices in the aggregate. Now, to do that, I'm going to look at household level behavior to understand the key mechanisms that are important for aggregate price effects. And then to quantify those price effects, I'm going to use those household level estimates to estimate a model. So in particular, we want to know two things at the household level. First, how much does rate lock impact moves from owning to renting? And second, how much rate lock impacts moves overall? The impact on moves from owning to renting is important for how rate lock affects aggregate house prices relative to rents. And the impact on moves overall is important for understanding how important rate lock is for individual households relative to other kind of non-financial reasons that somebody might move. Now, to estimate these key results, we're going to see how variation in a household's fixed mortgage rate impacts their subsequent moves. And to get kind of random differences in households' fixed mortgage rates, we're going to look at an event study from November 2016, where because of Trump's unexpected first election, the 10-year Treasury yield increased by about 70 basis points in the span of just a few weeks. We picked this because it's the largest and most unexpected month-over-month increase in the 10-year Treasury yield outside of a recession for the period that we have data. Now, in this figure on the horizontal axis, I'm showing households move-in date, and on the vertical axis, I'm showing the interest rate. And this figure shows how this sharp 70 basis point increase in the 10-year Treasury yield passed through to an almost one-for-one increase in 30-year fixed mortgage rates for households who happen to move just before relative to just after the increase. Now, since moving is usually the results of like months of planning, it's hard to time around these kind of high frequency rate fluctuations. And so people who moved in just before versus just after actually look very similar comparing them on age, income, and risk characteristics. Now, the one difference is that people who happen to move in just before the rate increase end up paying a lot less on their mortgage relative to those who move in just after the rate increase. Now, according to our framework, that means that people who moved in just after and have a higher mortgage rate face lower prepayment costs over the next few years, and so should be more likely to move overall, as well as more likely to move from owning to renting. And that's exactly what we see. So now I'm plotting percent changes in the probability of selling a home within 4 years based on mortgage origination dates, where percent changes are relative to the level just before the rate increase. You can see that this 70 basis point increase in households' fixed mortgage rates causes roughly a 30% increase in overall moves, plotted in blue, and about a 20% increase in moves from owning to renting, plotted in red. Now, this implies that rate lock reduces moves from owning to renting because people with a higher fixed mortgage rate are more likely to make the move. And it's the key result that implies that rate lock can impact aggregate house prices relative to rents. So now we're going to use these results to estimate a model to kind of quantify some of these effects. And our model has two goals. Now, the first is to estimate how much rate lock offsets the negative price effects of an increase in user costs when interest rates rise, where we'll use the model to estimate the price impacts of reduced moves from owning to renting that I showed you on the previous slide. And we'll also use it to estimate the price impacts of higher borrowing costs for new mortgages and a higher saving rate. Second, we're going to use the model to estimate the counterfactual impact of an increase in interest rates on house prices under three alternative mortgage contract types. We're going to consider mortgages that have adjustable interest rates rather than fixed interest rates. mortgages that are portable, which means that owners can roll over their current mortgage into a new property when they move, and also mortgages that look like fixed rate mortgages in Denmark, where borrowers have the option to buy back their outstanding balance at current market rates. Where if you think back to kind of the initial expressions I was showing you at the beginning, that means you essentially eliminate the rate lock incentive. Now, the structure of the model is going to be very similar to the kind of own to rent case that I was describing at the beginning, except now we're going to add some kind of empirical details. So there's still going to be a fixed population and kind of two housing market segments, but now there's going to be a time varying interest rate as well as time varying rents. Housing demand is going to come from households who are making two choices under uncertainty. The first is just kind of a standard saving consumption trade-off, where if you decide to save more, you get to earn the risk-free saving rate. And if you spend, you get some benefits to consumption. And they'll also make a housing choice, where they'll decide whether to stay in their current housing unit, move to a different owner-occupied unit, or move to a different rental unit, where any home purchases will be financed with 30-year fixed-rate mortgages. Now, equilibrium house prices are just going to equate the number of moves from owning to renting with the number of moves from renting to owning. And given this structure, an increase in interest rates is going to create mortgage rate lock. In particular, higher interest rates will reduce moves between owner-occupied units because the interest rate on a new unit is going to be relatively higher compared to the existing unit. And higher interest rates are also going to reduce moves from owning to renting because households expect basically a higher interest rate on a future rent to own move. And also because people want to essentially borrow at their low mortgage rate and save at their relatively higher risk-free rate, which, for example, you see advice that you should be doing that if you look on Reddit. Now, to estimate the model, we're going to target those kind of causal estimates from the 2016 event study, which means that we capture how people trade off rate lock and other reasons to move that are non-financial. Now, we're only going to be estimating using these kind of mobility effects, how rate lock impacts households' moves. But we find that when we run kind of the cross-sectional regressions that I was showing you earlier in the model, which I'm showing here in red, you get kind of modeled impacts of changes in the rate lock incentive on prices, which look very, very similar to what we saw in the data. So red shows results where we kind of simulate the cross-sectional regressions in the model, and blue shows the results where we overlay results from the twins estimate. And this is kind of a nice triangulation that shows this like own to rent mechanism that we're emphasizing in the model can capture a lot of the patterns that we actually saw in the data. Okay, so now let's use the estimated model for our two exercises. So first, we're going to kind of take the outstanding mortgage distribution in 2021 and simulate the impact on prices of an increase in interest rates like we observed from 2021 to 2023. And then we're going to decompose the price effects into impacts due to higher user costs and rate lock. So here I'm showing you existing home supply and demand curves, just like from the conceptual model, except now generated by the estimated model. Supply is the number of owners who become renters as a function of price. Demand is the number of renters who become owners. First, we're going to simulate the price impacts of an increase in interest rates, where we unexpectedly force all current owners into adjustable rate mortgages. You'll see a shift outwards in the supply curve and a shift inwards in the demand curve. And house prices fall by about 11%. This is sort of the pure user cost effect without fixed rate mortgages. To get the incremental impact of rate lock, we'll do the simulations where existing owners have fixed rate mortgages. That's going to attenuate the shift outwards in the supply curve and lead to house prices that are higher by about 6.4 percentage points. That means that on net, the increase in interest rates should decrease house prices by about 4%, holding everything else equal. So ignoring any changes in households' wealth or households' age or the preferences for owner-occupied versus rental housing. Now, this implies that rate lock is quite important at explaining aggregate price fluctuations in the recent episode. So our model predicts kind of a pure user cost effect of minus 11% due to the increase in interest rates, whereas we actually observed an increase in house prices of about 5%. Now, we estimate that rate lock can close about 1/3 of the gap between this pure user cost effect and what we actually saw. So that's obviously quite important, but it doesn't mean that rate lock is a full story for how you get to this actual increase. This implies that other forces, for example, changing preferences for owner-occupied versus rental housing, are potentially also relevant for understanding price changes in the recent episode. Now, of course, we don't just care about what actually happened, but what might have otherwise happened if households had different types of mortgages. So now let's see what would have happened if interest rates rose, but households had alternative types of mortgage contracts. So first we can consider if both owners and renters had mortgages with adjustable interest rates, like in Canada and the UK. Now, an increase in interest rates would just expose everybody to the higher user cost effects, decreasing house prices by about 12%. So prices would have fallen by much more than in the baseline case with fixed rate mortgages. Next, we can consider mortgages with the option to buy back the outstanding mortgage balance at current market rates. Now, this is actually the subject of one of those Wall Street Journal articles that I was showing you on the previous slide. And it's also the system that exists in Denmark. Now, this has kind of two offsetting effects. On the one hand, it eliminates the rate lock incentive, which means that when interest rates rise, owners are more likely to move to the rental market and house prices fall by more. But on the other hand, it also means that when interest rates rise, existing owners kind of get a realized capital gain on their mortgage, which makes them wealthier. Now, given our model, there's a kind of diminishing marginal returns to wealth. And so wealthier households are less likely to move from owning to renting, which means that higher interest rates have less of an impact on house prices in the aggregate. Now, it turns out that empirically, these two forces roughly offset each other, and the impact of an increase in rates with this alternative mortgage contract would actually be pretty similar to as in the baseline case. Finally, we consider an increase in interest rates where owners have portable mortgages that borrowers can roll over into a new property when they move. Now, this is going to, of course, eliminate rate lock looking across owner-occupied units, but it does nothing about rate lock between the owner-occupied and rental housing market, which is what's relevant for aggregate prices. And so an increase in interest rates actually has a pretty similar impact on prices as in the baseline case with portable mortgages. Now, the key takeaway from these examples is that the key friction that determines the price impacts of rate lock isn't that mortgages are, for example, non-portable or non-assumable, but rather that mortgages have a fixed interest rate. And so the only way to make house prices more responsive to interest rate changes is with adjustable rate mortgages. Now, I'll briefly conclude and then open it up for a broader discussion. We've seen that an increase in the local rate lock incentive causes an increase in local house price growth, where rate lock can actually elevate aggregate price rent ratios by reducing moves from owning to renting. And then finally, we've seen that rate lock meaningfully dampened the negative price effects of the increase in rates between 2021 and 2023, although it doesn't explain all of the recent increases. And fixed rate mortgages dampen the price effects of tightening, even without other types of mortgage market frictions. And so with that, I'm excited to answer some questions.
Thank you. This is a really, really interesting piece of work. And I also have to say, as a parent of twins, it particularly resonated, who both moved right before they were born and then right before they started elementary school. So the anecdote is that the data is true. I want to start just by exploring a little bit. I'm trying to think about, we don't talk a lot about the transition from owning to renting. A lot of the sort of public discourse is, how do we get renters into home ownership? And so, can you just talk a little bit about the logic of why, in your model, people, or in your observations of the real world, why do people go in the other direction from owning to renting?
Yeah, so I'll kind of start with the data and then maybe speculate about why. So in some sense, if there are a lot of people moving from renting to owning and there aren't a lot of new houses coming online, there have to be a lot of people moving from owning to renting as well. Empirically, we find that about 1/3 of total moves by owner occupants are actually an own to rent move. And there's sort of roughly two categories of people that this seems to kind of be driven by. So one is relatively older people tend to move into rental properties as they retire. And that could either be because, they don't want to be bothered with home maintenance, or because they have a lot of home equity that they want to consume in retirement. So that's one of the drivers we see. Another driver is if, you have a lot of uh, kind of changes in the types of housing units you prefer, either because, you need to be closer to work, or maybe you're okay with being farther from work. That also leads to moves from owning to renting. So, for example, like if you are moving from the Boston suburbs to downtown Boston, you might start um, by going from your owner occupied suburban house to your rented property in Back Bay. And then, if you, I guess, strike it rich in the hedge fund world, you can then, once you know the neighborhood a little bit better, purchase after that. So I think both types of these transitions are important. One thing I'll highlight is that you might think of the second type of move as like a temporary move where you're just trying to understand a neighborhood better before you buy. But kind of the price impacts of this rate lock thing are also likely to be somewhat temporary. And so over the horizon of, say, 2 to 5 years, where maybe you're learning about a neighborhood and are less likely to move from owning to renting as a result of rate lock, that's also kind of the horizon at which the rate lock effect operates as well. And so we should expect it to be important.
How do you think about there's a question noting that there are some folks who worry that the prevalence of fixed rate mortgages means that the Fed has less control over the economy and its ability to manipulate interest rates, suggesting that a system with more adjustable rate mortgages would give the Feds a little bit more power. Do you have a based on your work an opinion about whether that would be a good idea from a policy perspective, or would it impose even more losses and make the rate lock look even worse?
Yeah, so I think the results of this research implies that uh, with more adjustable rate mortgages, house prices would be more responsive to monetary policy shifts, to the extent that those changes in monetary policy, which primarily affect the short rate, actually do pass through to changes in the long rate. As to whether or not that's a good idea, I think that's a little bit outside the scope of my research. You can imagine some other benefits to having adjustable rate mortgages besides what I'm describing here. For example, people have discussed how when mortgages have adjustable rates, they're sort of automatically refinancing. And so that makes like the impacts of monetary stimulus more effective as well, because everybody immediately gets like a cash flow shock when interest rates fall, as opposed to having to wait for people to refinance. On the other hand, there's also kind of a benefit to households of having like the insurance that comes from a fixed rate mortgage. And so even if adjustable rate mortgages make prices more responsive to monetary policy for households, they might, not like the greater uncertainty in terms of what their monthly payments are going to look like. Um, and so it's not totally obvious that kind of net, the welfare effects are positive.
This is clearly beyond this question is clearly beyond the scope of this research, but I did find myself thinking about um, you're talking about how does this affect existing homeowners, and I want to I don't know what you if you want to say anything about the effects of interest rates on the decision of renters to become homeowners. I'm sure you've come across this in the literature, but what do we know about how that, again, that mortgage rate shock of the early 2020s affected people's ability to make the move in the other direction?
Yeah, so I mean, that one is, I think, a lot more unambiguous, where when interest rates are higher, people are less likely to move from renting to owning, either because, debt to income ratio constraints start to bind, or just because, the cost of borrowing is increased. And so it's less financially worth it relative to renting. That's kind of I would think of that as like one of the standard things that people think about when they discuss like a user cost effect of higher rates. There's sort of two wrinkles to that. So one is when mortgages have fixed interest rates and there's an option to refinance, that also means that an increase in interest rates should dampen um, renter demand by less. So this is like Ed Glaser has a paper about this, where people anticipate the option to refinance. They expect interest rates to fall after an increase in interest rates. And since they expect to stay in their home for a long time, that means, you know, the option to refinance has less of a negative effect on demand when rates rise. So I think that's a potentially important aspect of this too. Um, yeah.
And again, if I'm understanding this right, the rate lock effect is also just decreasing the supply of housing that might be available to renters, which is going to make life just even that much harder.
Right. And so this is kind of an over and above kind of incremental effect where, also because owners aren't selling, that means like there's relatively higher prices as well, which, you can think of that as like movement along the demand curve as opposed to a shift in the demand curve.
Do you have some thoughts on, we've seen, well, we saw some recent declines in the interest rate. It's hard to figure out what's going to happen in this specific moment, but how much in your mind would interest rates have to come down um, to make most of the rate lock effect, go away, disappear, whatever word you want there?
Yeah, that's a good question. I haven't literally done that analysis. I think some of the back of the envelope things that I've been able to do is like uh, just based on kind of typical turnover in housing markets that's not responsive to interest rate changes. After roughly 5 years, you should expect the rate lock effect to decrease by half. But
Say that,
that's sort of
say
notwithstanding.
that again.
So like just based on typical churn and when people move, like there are a lot of moves that happen, for reasons that aren't related to, interest rate shocks, like deaths or, health shocks or all these kind of things. And just based on historical patterns associated with that, you should expect, the size of the rate lock incentive to go down by about half within 5 years, even if interest rates stay constant. So you should expect that, the decline in interest rates should accelerate that decline.
So the sense in that case of homeowners is essentially saying, I really do want to move.
Yeah.
I don't think interest rates are going to come back down. Let's get on with it. So whether we think
Yeah.
it's going to be sticky or not. Did a couple questions that sort of relate to methodology, and I think this will be our last one,
Yeah.
which is to what extent or how did your modeling take into account both the potential tax implications, particularly of moving from owning to renting, and also the
hmm
potential tax implications of capital gains. I think you had a mention of capital gains, but um, how does that get either of those get incorporated into the model?
Yeah. So I mean, we take into account kind of the capital gains treatment of existing home sales and things like that, just explicitly. I think the potentially the right way of thinking about it is, if you're taxed on capital gains in home equity, then um, house prices have to increase by a relatively larger amount to make you willing to sell.
Okay.
Um, Relative to like if there's a step up basis at death, and so if you die in your home, then that's better for your heirs.
Let me just wrap up. I think it's just a wonderful piece of research. I thought it was interesting, a couple of years ago when you came looking for funding. I still think it's really important, and I really appreciate how you've unpacked, put some pretty rigorous estimates on things that we're pretty sure were going on, but I think didn't know the effect. I'm just wondering, as you went into this, is there any finding that had particularly surprised you, either was counter to what you thought, or just the magnitude was either much larger or much smaller than what you found?
Yeah, so I think there are kind of two things maybe. So one is just like the twin stuff I thought was interesting. I didn't necessarily expect the research to go that direction, but it's always fun when you find things like that. Maybe more substantively, I think the way that people have been discussing rate lock kind of in the popular press and among economists was this is really something that affects moves across cities. And so you should expect it to impact like the relative price of housing in San Francisco compared to Miami, because you're stopping people from moving along those margins. I actually found this is not something I mentioned, but I found that that's not the case, and that rate lock basically only impacts moves within a city.
Hmm.
And I think if you think about it for a second, that actually kind of makes sense because why do people move across cities? It's usually because they get some huge shock that impacts, their life in ways that would totally overwhelm this $30,000 present value incentive to stay. Um, but it also means that I think maybe some of the intuitive arguments that people were thinking about for why this might impact prices actually aren't quite right. So that's one of the reasons I ended up focusing on this like own to rent margin as opposed to looking at relative price effects across cities, just because the own to rent margin is actually on within city moves, and you actually do see a pretty important impact of rate lock on that margin.
Well, we've come to our time, I'm again, as I said, I think this is really wonderful research because it, puts, I think, some hard estimates on something that, as you were just saying, has been in the discourse, but it's not clear we actually knew what was going on. And more broadly, the Meyer Dissertation Fellowship, which was actually, I believe, the first fellowship that was offered by the Joint Center. We've offered it since the mid 90s. It's really designed to try and encourage young scholars, and also allows the Joint Center to support work that goes beyond what we can do in our core research. I think this is a wonderful illustration of the kind of work that's really important and that we're really thrilled to support. And then Michelle Lee's presentation, as I noted, coming up in a couple of weeks on a very different kind of subject, but again, something that intuitively we know is interesting. So I want to thank you for a really clear presentation, walking us through a pretty detailed analysis, and then landing on some findings um, that have some really broad applications. So thank you for a terrific piece of work, for a terrific presentation. I hope everybody has a great day, and again, look forward to seeing some of you online for our release of the rental report and then future housing seminars. Have a great day, everybody. Thank you, Justin.
Thank you. Bye.